These are the largest university endowments in the world, and this is Harvard. College tuition keeps reaching record heights year after year, and students are graduating with 5 and 6 figures of student loan debt. But endowments haven't always been this big. Something happened some 30 years ago that changed university endowments into financial institutions. So I went searching and found out how Harvard's endowment really works and who's really benefiting.
Harvard significantly increased their exposure to hedge funds, doubling it to something in the order of $13 billion.
Private equity has been a driver of our returns over the last 10 and 20 years.
So this is how an endowment is supposed to work. Say you donate money to a nonprofit organization's endowment. Traditionally, the endowment would take that money and invest it in stocks and bonds. As that money grows and earns its rate of return, the university will pull, say, 4% of it out to use, allowing the rest to keep growing. And it essentially stays that way forever, growing larger and larger every year. Plus, most universities are nonprofits, so technically, they don't have to pay taxes on any investment earnings they make. Just like hospitals and churches, they are exempt from the 15% capital gains tax. But we'll come back to taxes. Now, Harvard's endowment started all the way back in 1638 when John Harvard gifted 400 books and half his estate to the New College in Cambridge, which they then renamed to Harvard after his generous donation. And from then until the mid-20th century, the endowment was invested in mostly fixed income investments like bonds and blue chip stocks. By 1974, the fund had grown to over $1 billion, so on the advice of some alumni in the financial world, they decided to create the Harvard Management Company and bring most of its investing in-house, which helped them be a bit more strategic in the 70s and 80s to grow the endowment. But it wasn't until the late 80s when the jet fuel ignited, and for that, we can thank this guy, David Swinson. He spent time at Salomon Brothers and the Lehman Brothers before taking over Yale's endowment in 1985 at just 31, and his approach was drastically different. He built what is called the Yale model, basically the gold standard that all endowments run on now.
Diversification is a free lunch. For a given level of risk, you can generate higher returns if you diversify.
Specifically avoiding asset classes with low returns like fixed income investments, which was historically what endowments did. It's safer. But he saw the real money was in alternative investments like private equity and hedge funds, which are way riskier. However, Yale had the edge to help mitigate some of the risk.
We have alumni working in these funds, so we can get a better deal.
And so from 1985 to 2005, David grew Yale's endowment by almost $8 billion. His alternative investment master plan was working, and it didn't go unnoticed because by the time Jack Meyer took the reins of the Harvard Management Company in 1990, he was ready to unleash the Yale model. And boy, did he. Jack took the Harvard endowment from $5 billion in 1990 to over $25 billion by 2005, and it now sits at $50 billion. Now, every year Harvard releases a financial report, basically saying, look how much money we made. And this is how they have the endowment investments broken down. Naturally, the big two are private equity at 34% and hedge funds at 33%. None of this would be possible without their donors. They are the real driving force behind an endowment. And when it comes to Harvard, their donors are flush with cash. In 2018, the university received $1.4 billion in donations alone from alumni, foundations, and even countries. Yeah, foreign funding pours into the endowment. Just look at this, look. From 2019 to 2022, they brought in $385 million from 46 countries, with China outspending England by almost double. And when it comes to alumni, boy do they love their alma mater. In 2022, Hans-Georg Wyss donated $350 million directed at the Wyss Institute for Biologically Inspired Engineering. In 2009, he gave $125 million to help create the Research Institute at the university. Then he donated another $125 million in 2013 and $131 million in 2019, totaling over $700 million to date. In 2015, hedge fund manager John Paulson gave $400 million to the engineering school, which they then renamed to the John A. Paulson School of Engineering and Applied Sciences. And in 2023, hedge fund manager Ken Griffin gifted $300 million to the Graduate School of Arts and Sciences. Kind of sensing a theme here, huh? Something about hedge funds and private equity managers and the endowment. Unfortunately, when it comes to investments, the endowment is pretty tight-lipped about what they actually do with all that cash. The most it will say is that it's got $18 billion in hedge funds and $20 billion in private equity. Fortunately for us, some of their investments have come to light over the years, so we pulled some of them together. Private prisons. Starting off hot. This one might be more through association than pure investment, but nonetheless. Through its ETF holdings, the endowment invests in companies that operate private prisons like Core Civic and GEO Group. Puerto Rican debt. Yes, those words just came out of my mouth. The university invested $2 billion in a Boston hedge fund called Baupost Group, which is run by Seth Klarman. Baupost Group held about $1 billion in Puerto Rican's $70 billion debt during the Puerto Rican debt crisis. Profiting off of the crisis. Not a good look. China. I'll be honest, I have nothing truly concrete to report on that except a House Select Committee naming Harvard as one of the tax-exempt college endowments it wants to divest from China in new legislation. There's money there somewhere. Vineyards. Bunch of winos in the endowment. It owns a company that bought up over 10,000 acres of vineyards and farmlands all through California's Santa Barbara region. Sticking to land investments, Harvard poured almost $1 billion into buying up farmlands. They amassed around 1 million hectares ranging from Brazil to Europe to South Africa. In Brazil alone, they spent $500 million on 400,000 hectares. That's an area twice the size of all the farmland in Massachusetts. And these are just a few of the investments that have leaked over the years. We didn't even touch on the battle between fund managers and students over divesting from fossil fuels.
Huh? Oil? Who said something about oil you cooking?
The more and more you read, the more it makes you wonder, who is the endowment really serving by taking all of these risks?
A lot of these Harvard alumni work for venture capital firms, private equity firms, firms funded by private equity or venture capital. So what are they going to tell the board of advisors and, the alumni office? And they say, venture capital is a really good thing and you should put more money in it.
Our friends over at Good Work also dove deeper into the endowment world. So check it out.
People often think of an endowment as a humongous Santa Claus bag that colleges can reach into and make it rain whenever they want.
Now, hedge funds operate off of a 2 and 20 rule. They take a 2% management fee on total assets they manage and 20% fee on the profits the fund generates. Seth Klarman with the Baupost Group, the fund with the Puerto Rican debt, Harvard had $2 billion invested in his fund. That's a pretty big payday off of the 2 and 20 rule for Seth. So who's making money? The alumni, the hedge fund managers. This entire ecosystem is set up as a you scratch my back, I scratch yours kind of system. And I say all this not from a place of malice, but from a place of who is the fund truly serving? Because for something they claim is being built for university longevity, it's not bulletproof. And 2008 proved that.
Now it's official, we are in a recession.
NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
After years of leveraging risky assets, when the market imploded, the endowment lost 30% of its value. It left the university scrambling to cover operating costs. So in one of the biggest financial meltdowns in history, the endowment, which is supposed to be a pillar of strength, left them high and dry. Instead, the university had to make huge budget cuts to financial aid, research spending, and had to make widespread faculty layoffs.
You invested in the financial markets, you take a lot of risk, and then you're telling me that when times are tough, you spend less from the endowment. I remember being in the classroom and it hit me in the face. It's like, how can it be that you're building this savings account and you refuse to use it in bad times? Because the donation stream doesn't stop. Harvard alumni keep providing donations, day in and day out.
Which is part of the reason the US government recently placed a 1.4% tax on investment earnings if the total endowment value is worth more than $500,000 per student. Harvard sits around $2.3 million per student. And besides generating tax revenue, it was a nudge to say, hey, if you're gonna parade around these massive endowment numbers, we're gonna make sure you're at least spending it too. So the option is either spend more of it or accept more students to the university to get a lower per student endowment number. This move also aims to help improve the health of higher education as a whole. Everyone wants to be like Harvard, but it doesn't mean everyone should be.
If you're a small liberal arts college, you don't come in as a general partner. You come in as a limited partner. And you don't have access to the best fund. You'll have access to the worst funds because you're not as well connected and you're second in line if you want. And I often say that the success of Yale has been a disservice to many, many small universities. Your role as a small liberal arts college is to educate, not grow the endowment.
The job of higher education is to educate and to produce knowledge, but Harvard's endowment just doesn't see it that way. And that's why Harvard is a hedge fund that sometimes teaches.